Hello, welcome. This is Trading Mastery Academy. I want to make a video on a very important subject that will not require us looking at the chart. But I believe it is the secret to becoming a profitable forex trader. If you want to be a forex trader that is consistently taking money out of the market on a daily, on a weekly, or a monthly level, you want to give attention to what I'm going to review to you in this video. So like I said, we're not gonna do anything on the chart. But if you miss picking these elements in your trading, then no matter how good you are technically in the chart, you cannot make money consistently in the market. So what I'm going to discuss today is risk management. Risk management. That's what I want to talk about in this video. Now, what is risk management? Risk management is simply risking a certain predetermined percentage of your capital, or your overall current balance. That is risk management. Of course, all of us, no matter where we are in our journey, we understand that we want to, there's a certain percentage of our capital that we should put at risk in every particular trade. Each trade we are putting, each trade we are buying or selling in the market, there is a percentage that we are risking. So I want to ask you, what is the right percentage that you should put at risk in the market? Of course, that will depend on our risk appetite. But if we want to really be profitable in the market, want to be consistent, and we want to stay long in the market, if we're looking at the market on long-term basis, we need to risk the right percentage. Now, for beginners, those who are just coming into the market, the right percentage to risk is 1% of your account. 1% of your account. Now, if you risk 1% of your account, the advantage is that you will stay longer in the market, because when your trading is highly technical, it is highly technical. It is not something you just come in and then you master and then you begin to kill the market, begin to hit home runs and all of that. So that is why at the beginning, you want to manage your risk, so that, because when you're starting out, you will be more wrong than you are right. So if you are risking more than 1% of your capital or your current balance, you will see that because you are more wrong than you are right, it will come to a point your account will be blown. That is what it is. Actually risk management, not technical knowledge, that actually leads to blowing of account. Now, when you risk 1% of your account, when you risk 1% of your account on each trade you're buying or selling, it helps preserve your it helps to preserve your capital. Now, the question is, how do you determine 1% of your capital? For those of us who are very good in maybe calculation, you want to divide 1% of your current cap balance by the trade stop loss. If you divide, if you get 1% of your 1% of your trading capital. For example, if you have $100, 1% of $100 is $1. That is what it means, that in each of your trade, you should be putting $1 at risk. So what it means is that it will take you losing 100 trades before your account will be finally blown. And of course, that will take a whole lot of time. But if you're risking, like most persons, they put between 5% to 10% of their capital at risk when they are starting out. So if you put 5% of your capital at risk, it means that if you have $100, by the time you lose 20 trades, your account is blown. If you risk 10% of your capital on your 10th trade, or even less than your 10th trade, your account will be blown. And of course, we know individuals that just one bad trade leads to blowing of their capital. So that is poor trade money. That is poor risk management. So you want to preserve your capital, because it is only when you have capital, that's when you can trade. Now, so how do you get 1% of your trading capital? How do you ensure that at every trade that you are taking, that 1% of your capital is at risk? Like I said, you want to divide 1% of your current balance by the trade's stop loss. And then you move the decimal point to the left 1 digit, which will give you your lot size. Because it is your lot size that determines how much of your capital is at risk. So if you have $100 and you are using a lot size that is larger than the lot size you're supposed to use, in that case, you have a blown account. Though you have a blown account. So let's say you have $1,000. You have $1,000. You have $1,000 to trade. This is what you have in your capital, as your balance. Now to get 1% of your balance, what you do is you move your, so to get 1% of $1,000, 1% of $1,000 is $10. So meaning that if you have $1,000, you want to be risking $10 on each trade. So it will take 100 trade before this $1,000 will be blown. So how do you get the stop? How do you get the correct loss size to put, so that when the trade does not go in your favor, you will lose just $10? Now you divide, so 1% of 1% of $1,000 is equal to $10, equal to 10. So that is 1% of $1,000. So let's say you're using a stop loss of, usually people use stop loss of, let's say 30 pips stop loss. The stop loss is 30 pips, or a 30 pips stop loss. To get your loss size, 30 pips SL. We're using a stop loss of 30 pips. So to get your loss size, you divide 10, which is your 1% of your capital, by your stop loss. So if you divide So if this is your stop loss, this is your capital, then your lot size. To get your lot size, will be is equal to your 10 divided by your 30, which is equal to 0.333. So the next thing you do is to move your decimal point to the left 1 digit. So if we move this decimal point to the left 1 digit, that will give us, so our lot size will now be, sorry, our lot size will now be, if we move it 1 digit, it will be 0.03. So that's your lot size. So for a $1,000 account that you're risking just 1% of your account, you use a lot size of 0.03. So 30 pips, by the time it moves 30 pips, what you just lose is $10. But this is a lot of calculation. For those persons who do not really like doing mathematics and all of that, so let me show you just how easily, oh my. Okay, so for those of us who do not like doing these calculations, doing this manual calculation of getting 1% of our account, then dividing it by our stop loss and moving the decimal point 1 digit to the left, you can simply use my FS book. When you log into my FS book, the home page, you come to Forex calculators, then position size calculator. My FS book, home page, Forex calculators, position size calculator. So you have this dialog box. So let's say the currency pair we want to trade is the Euro USD. Our currency is denominated in USD. Our account size, our account size that we are using is for this calculation is $1,000, and we are risking how many percent of our capital? 1%. So you come here, risk, you put 1%. Then our stop loss. Of course, your stop loss, we don't use mental stop loss. So your stop loss is actually gotten from the structure of the trade that you're taking. That's where you get it. But we're just using 30 pips as an example. It doesn't mean that every trade that you're taking, it must be 30 pips stop loss. This is just an example. So stop loss of 30 pips. And then for the trade size, it's just 1. So you leave that, you don't touch anything there. and then you calculate. So when you calculate, you see, so 0.03, exactly what we got from the manual calculation that we did. So this one is faster and is less stressful. So you just come to myfsbook.com, you put your capital, you choose your currency pair. Of course, when I loaded the page, Euro USD was just there. I'm using it as an example, but you have the choice of choosing the currency pair that you are trading. So we have all the currency pairs are here. So you choose the one you are trading, that you want to enter the trade for. The currency, the account currency here is usually denominated in USD, except otherwise. So if it's denominated in euro or pound, you can also choose that. And then you put our account size of $1,000 that we're using for the example. So if you have an account size of 100, so whatever is your current balance is the account size. Whatever is your current balance is your account size. So you put that here. And then your risk. What percent of your capital are you risking? You indicate. So 1% of your capital. 1% of your capital. Your stop loss that you've determined from your structure and your technical analysis, you indicate that, and then you calculate. So it will give you the exact loss size that you're supposed to use. So because when you don't get the correct lot size that you're supposed to use, that's where we get blown account. Because I remember starting out where we had a mental stop loss, where if it is said that if you have $1,000, you should use 0.10, you have $2,000, 0.20, you have $5,000, use 0.5. But of course, that is wrong. That is wrong, because what is supposed to determine your lot size is one, your current balance. Your current balance, the capital you have in your trading account. That's what determines the loss size that you're putting for each trade. And then after your loss size, then the stop loss, the amount of stop loss. Now, because our stop loss is 30 pips, we see that the right loss size to use for us to lose just 1% of our account, which is $10, is 0.03. But if I reduce the stop loss to 20, if I reduce the stop loss to 20, you see that the loss size increases from 0.03 to 0.05. It increases. So if I reduce it to 15 pips, because sometimes your analysis, you can have a little stop loss depending on the time frame that you are doing your analysis on what you also use in your technical analysis. So, but if I reduce the stop loss to 15, you see that I can put 0.07 and 15 pips. When the market moves 15 pips up against me, I will lose the same 1%. But what if I increase the stop loss? What if the stop loss increases? What if the stop loss increases to 40? You see that the same 0.03 will still make me lose 1% of my capital. But what if it increases to 50? Because sometimes it's possible, depending on the time frame that you are doing your analysis on. So in this case now, the stop loss, the loss size reduces to 0.02. So if I have a loss size, if I have a stop loss of 50 and I am using a stop loss of 0.03 or 0.04 or 0.05, or I am using, like, because I have $1,000, I am using 0.50, because 0.50, it means that each pip movement is $5. So what I'm going to lose is $250. $250 if I use 0.05, because it is said that when you have $1,000, use if you have $1,000, you use 0.1. 0.10. Okay, so if I use 0.10, 0.10, and in that case, each pip movement is $1. So 0.1 times 50 is $50. And $50 is 5%, 5% of your capital. And for individuals who are just starting out, so they will not be able to handle losing 5% of their capital at once. So because of that, you want to revenge trade, you want to get back the money immediately. And we know how big $50 could be now based on the exchange rate between the Naira and the USD. So it could be very large. So these are the things that causes struggle, make people begin to revenge trade, want to get back the money, and then the account is blown. So if you want to preserve your trading capital, you want to risk a predetermined percentage of your overall capital or your overall balance. Like in this case, 1%. Because you're still working on your technical skills, you're still battling with psychology and trying to understand yourself. So this is not a moment where you want to be hitting home runs. You want to double your account with one trade. No, because when you do that, you will have a blown account. Your account will definitely blow. And when it blows and you start looking for money again to fund. So you don't want to do that. So you cannot grow an account consistently without applying proper risk management. So this might sound very, very odd, very, very funny to most of us, especially those of us who started risking so much of our risking very high percentages in each trade. So it's going to be a battle to begin to make these adjustments. But for those who have actually blown accounts, live accounts in the market, so you want to start applying this risk management in your trading, because I know it's not going to be easy. It's not going to be easy, but it takes discipline. It takes discipline to actually start applying risk management in your trade. But if you want to be a forex trader, you want to trade for long, you must apply risk management to your trading, because risk management is the only thing that will make you to be consistent. So though it is not easy, but it is a skill that can be learned. It actually calls for discipline. And when we talk about discipline, what is it? Discipline is when I don't want to do it, I still do it. The natural tendency is to risk more so that you make more very fast. But for you to be a profitable trader, you need to be disciplined. And discipline is when I don't want to do it, I still do it. So when you do that over time, so you can start applying it in your demo account. You want to start applying it, do the calculation. Each trade you're entering, you want to know how much am I going to lose. You want to determine, because this is your hard-earned money. So you don't want to lose your money and then you run back to looking for capital again to fund, because it is not easy. It's not easy, actually. So it's your hard-earned money. So the first thing you want to do is you want to protect your capital. The first rule of trading is protect your capital. Because when your capital is protected, when you have something in your balance, that's when you can trade. When you have 000, or maybe your broker calls you a margin call that you should go and fund more. So it becomes difficult. It makes trading stressful. But when you gradually learn to be disciplined, learn to begin to apply risk, management in your trading. You gradually transform yourself to that point where you now begin to look for profit, not home runs, but you start gaining, you start growing your account little by little. Now, you might start wondering that is it possible to actually make money applying, just using 1% of our capital? The answer is yes. You can actually make money. You can grow an account over time applying just 1% of your capital in each trade. Now, let's say that you took 10 trades. You took 10 trades, and out of the 10 trades, you won the first trade. First trade, you lost. The first one was a loss. And how much have you lost? 1%. Equal to 1%. You entered another one and you still lost. And there is no shame in that. Losing is part of the business. So your second trade, you still lost. There is no shame in losing. Your third trade, because you're still developing your skill, you still take a loss. So you've lost 3% of your capital. Just 3%. And will that be painful? No. Because if you have $1,000, what you've just lost is $30. You still have $970 to trade. So let's say your next trade now, you now have your next trade. You have a win. Your next trade, you made money. You made some dollar. And because it was a trade that you risk a 1 to 3, you made some dollar. That's 4. You've taken, so you see that just this trade alone has cleared the 3 losses you have cleared the 3 losses that you took. So let's continue. Your 4th trade, you still lost. You lost your 5th, and then here you won another on your 6th. Your 6th trade you won, but you've lost 5. Let's say you still lost another. No shame. and then you want your last your last 2 trades. You made some money here. Okay. So so you took 10 trades, you lost 1, 2, 3, 4, 5, 6. You lost six of them and won 4 of them. You won 4. That's 40%. Normally, that's not supposed to be a win, but in Forex, your total loss is here. Total is equal to 6%. 6%. Why your total wins here? Why your total here will be 12%. Because you're holding your trade, the ones that are going in your favor, you are using a risk reward ratio of 1:3. So if we minus 12, if we do 12 minus 6, we're going to have 12 minus 6 is equal to 6%. So your 6%, meaning that you've grown your account from $1,000 to $1,060, which is a good increment. So let's say you did this in a month. Is it a good return? Yes. You want to consider how much does the bank, if you have kept $1,000 in the bank at the end of the month, would the bank have given you 6% of the capital you deposited with them? Of course not. So if you can imagine, when you do this for 6 months, you do this for 1 year, and of course, as you're remaining disciplined and applying risk management to your trades, to get to a point that even your win ratio will increase, and gradually your account will begin to also increase. So that is why you want to apply risk management to your trades. You want to stay disciplined. You want to know what you are risking, what you're going to lose if the trade does not go in your favor. This is actually the secret to becoming a professional forex trader. So guys, I hope you enjoyed this video. See you in my next video.